The whole point of today's topic is to just inform, and to educate, but not to advise. The key takeaway from this is that there's always risk with any investment, and every aspect of this that you're seeing, it's always good to get professional, tailored advice. And disclaimer as well, again, that this is not financial advice, it's just for education purposes, but again, come see us.
My name's Carla and I'm the director of one of the YPA estate agencies. We have 25 offices in Victoria and one in Queensland, and we're growing. Just giving some facts and information about the different types of property investments available, and just here to give a bit of information.
Today we'll be going through just a lot of the basics in regards to investment properties, some of the benefits of investing into property, using an agent, which is, we have one here today, in regards to managing your investment properties, tips for investing, going through, I'll be doing a small case on negative gearing, tax implications of investment properties, and this is an important one, tips for selling investment properties. At the moment, if we go back, so we're in December 2024, so if we go back probably 2 or 3 years ago, most of my clients, if I was to have a property meeting with clients, 3 out of 4 property meetings with clients will be relating just to purchasing properties, and that was before COVID. They're like, if I purchase a property, how will this impact me? It's the other way around now. 3 out of 4 meetings relating to property is, I'm struggling, I'm thinking about selling my investment property. How is this going to impact me in selling the investment property? So you will go through as well, and in regards to the market conditions and timing the market. So these types of presentations actually not a bad one, because if you're not in the market, and a lot of my clients and a lot of potentially other people's clients are thinking about selling for interest rate reasons or whatever else, that could be actually time to start thinking about, should I be getting into the market? You would have heard on the news, I think it's about half the country now, the property prices are going down, I think.
I wouldn't say down, I'd say they're probably stabilising a little bit.
That's because you're optimistic, yeah.
Of course I'm optimistic, no, yep. But compared to 2021, yep. Late 21, early 22, with the changes in the interest rate rises, we're seeing the after effects now, yeah. Where it's a bit more stagnant. So, things that were spiking before are just a bit more slowly.
Stable.
Stable.
Yeah. What's your take on it?
Well, I think the key is for every seller there's a buyer as well, right? So that's the key there. And I think the good properties are definitely selling still well and truly above where the advertising range is in some instances, and others are taking a long time, and depending where it is as well, like location down in Peninsula, for example, is taking 2 or 3 months versus a month back in 3 or 4 years ago. So I think it's very much by location, and definitely there has been a pull-off in pulling back in regards to Sydney and New South Wales prices and WA prices, we're finding as well, where people are now starting to look at other markets, and Victoria is definitely getting a lot more interest than it was a year ago, for example.
So the definition of investment properties. Investment properties are real estate properties purchased with the intention of generating income or appreciation. Investors can generate income through rental payments or appreciate their investment as the property value increases. So there's different types of properties as well. Single family homes, like one home on a large block, like a full block. Multi-family homes, so multi-dwellings on the one block, maybe subdivided, and commercial properties as well, which we're going to touch on all 3 of those. Start off with the single family homes. They're probably the most popular, easier to finance overall and manage, and have a lower turnover typically than other types of properties. The multi-family homes that we touch on are properties that have 2 or more dwellings on a single land parcel. They offer higher rental income potential than single family homes, but they can be more difficult to manage just due to the number of properties in the one spot. Commercial properties, they include like retails, factories, industrial properties, investment properties there. They offer higher potential for return, but can require more management, and there is often a higher vacancy rate. So They need to have the right tenant, and depends on what their business is.
So if we go through I like to sort of discuss everything, an element of risk. Single family homes will be dealing with any type of investment, there's always a risk. Single family homes usually are the lower risks, so people tend to hold on to them for longer. They tend to appreciate in value. And the key as well is that whenever you're buying a property, you're buying two things. You're buying the land and the stuff on top of the land. In most cases, the land usually, and I say generally, the land goes up in value quite significantly. So you'll have a situation where the land's going up in value, but the stuff on top of the land tends to go down in value. Because as a house gets older, it's worth less to replace. So you find that sort of tends to go up like that. So the stuff on top's pushing you down. So for the single family homes, because most of the portion that you're buying is just the land, they tend to be less risky. Multi-family homes or things like an apartment complex, everyone's sharing just that one little parcel of land. Whereas there might be a situation where right next door the another apartment complex goes up as well. So you tend to see them as being a little bit more risk. In regards to clients losing money, again, this is just generally speaking, what we do find is that in a lot of cases, those that are buying apartments are the ones that do end up losing some money. In most cases, it is quite rare to see clients lose money if they hold on to it for long enough on the family homes. But in apartments, there is an element of risk on it as well. Some clients do make a lot of money with apartments, but in a lot of cases, they can potentially lose as well. But that's got to do with the yield, and we'll go through that later.
Yeah, and I think you're probably referring to at the time of sale, more so than during the actual
period. During the investment period, you can actually get a good return. Commercial properties, again, this is just talking about the sale price, purchase versus sale price. Commercial properties, I would classify as more higher risk, higher return. So you might have a situation where you buy something for $1 million and it goes to $2 million relatively quickly, or buy for $1 million and it's worth $200,000-300,000 worthless very, very quickly.
Depends on the tenancy.
Correct.
Well.
Yeah.
You've got a strong tenant in there.
Yeah. So if you notice for buildings like this, for example, you've got to make sure the occupancy rate's high, because the entire value of this building, the bulk of the value of this building, is relating to the occupancy rates of commercial properties. So if you've got a long-term tenant, you're sweet. If that tenant leaves, and I'll give you an example where I was managing a very large fund, one tenant left, couldn't replace that one tenant, and the entire property portfolio fell just because of the commercial property and one tenant.
Okay, so engaging with an agent can reduce the workload in managing an investment property. It can also reduce the risks involved in managing an investment property. So agents, we help find tenants, we thoroughly screen potential tenants, set rental prices based on local market conditions, handle maintenance requests, coordinate safety and compliance, and manage minimum standard legislation, which those two last items have become major things in Victoria in the last few years. So you kind of need a degree to be able to decipher some of these points. So we just basically make sure that the gas, electrical and smoke alarm safety is up to date, because there's huge fines for landlords and agencies if you're not on top of that all the time. So working with a reputable agent can help mitigate the risks associated with investing in real estate. So you can, rest assured that we've got your asset looked after very well. Okay, so why investment properties are a good choice as part of your portfolio? So stable cash flow. So investment properties provide a stable cash flow through rent payments that can provide a steady income stream for investors. Appreciation potential. So investment properties also offer appreciation potential, meaning the value of the property is likely to increase over time, providing investors with long-term capital gains. So that was something that we were touching on before, the difference between a home on a full block compared to an apartment. Sometimes I've noticed as a real estate agent that we get higher rent, higher yield for apartments, but then when it comes time for selling, I think that's what Mark was alluding to, sometimes you notice the difference in when you're trying to sell the apartment, because there's a lot more on the block. They're generally not as unique as a home could be. Major life changes. So events such as marriage, birth of a child, job relocation can influence the decision to invest in property. These milestones often lead to changes in financial priorities and can create opportunities for investment. For example, moving to a new city for a job might present a favourable real estate market. You might decide to dabble in the market that you're moving to. birth of a child, you might think it's time to set yourself up for your future and buy a property.
This is a sort of an unfortunate thing to talk about, which is the inheritance. In a lot of cases, events occur and you've inherited some funds. We had a seminar, the last seminar I just spoke pretty much in detail regarding that. So in the event that you do get a bit of a windfall, then in a lot of cases that may provide opportunities which weren't there. These opportunities even for first home buyers, could be for grandkids, could be for anyone. So in a lot of cases we are seeing that change from generational wealth. And when we do start to see that, we are starting to plan for that as well. So it's very important to know that, there are situations where, you may be inheriting some money and then you'll be looking to invest that into some of the lower risk assets or even potential properties as well. The last one is preparing for a retirement income. This is something that we tend to do with a lot of clients, is look at their property portfolio when they're in their 40s, their 50s and their 60s and start working out, well, what investment properties should they be looking into? Should they be looking at buying and selling? If they're in their 50s, for example, they want to work for the next 15 years, what type of investment properties should they be looking into? Have they sold a business recently and they want to park those funds somewhere before they hit retirement? So it's a good avenue to start thinking about cost-effective and tax-effective methods to start thinking about, okay, well, I'm going to look at buying an investment property. George brought it up as well in regards to buying investment properties in self-managed super funds as well. We do have quite a few clients that are looking into that. They want as part of their property portfolio or their investment portfolio have some equities and some superannuation as well. Tax benefits. So there's a lot of major tax advantages. I'll be running through the tax benefits a little bit later when I go through a worked example on it. But one aspect of buying an investment property could be, okay, I'm paying too much tax, Mark. How do you save money on tax? I'm like, okay, buy an investment property. It's not that simple, but in reality, it could be depending upon the situation. There are some really big tax benefits. It's been in the news now. Like I mentioned, it's the tail end of 2024. At the moment, there's some really big tax incentives. One is negatively geared properties, and we'll work through that example. That hasn't changed yet, but they've been talk. The ATO brings out and releases and says, okay, these are the tax benefits if we did change this legislation. Same as capital gains tax exemptions as well. There's some really great ones out there. While they're still out there, people are using them. Keep in mind though that a lot of people, a lot of clients of mine that are investing into these things are just mum and dad investors. There are some really high net wealthy people doing it purely for tax benefits, but a lot of them are actually, the tax benefits is what's really pushing them to say, okay, I will get into it. There is a little bit of a benefit for me as well. Diversification. This is an interesting one because as you start progressing through life, you hit sort of that 30s and 40s, and you've got an investment property as in your primary residence property, and you've also got your superannuation as well. So you've got two avenues or two assets that are going up in value. And you might be like, okay, well, I need to get that third asset as well. I want to try and grow something while I'm still relatively young, and I want to go, okay, I want something else to accumulate in value. So one thing that a lot of people do start thinking about is, well, okay, do I go out in business on my own? And a lot of them do say that. They say, okay, Mark, I'm hitting my 30s and 40s. I'm going to go out in business on my own. I'm going to have invest. But a lot of clients of mine, they have a really good and stable job. They have fantastic employment history. They've got a really great career. They don't want to do that. With those types of clients, it's always a good idea to start thinking about, well, how do you create that third avenue of growth? And that's where an investment property is a really good idea to start talking. Again, talk to your accountant first, get all the facts and figures. And then if it does work out for you, it'll provide another, like a third lane, so to speak, of equity growth. Okay, tax benefits of investment properties. The key is at the bottom. Consult tax professionals to fully understand the benefits of it. But in short, I'll summarise and I'll run through it a little bit more in detail. So if any of you have done accounting in high school or back in history, You've got your income, which is, you know, the amount of money, and then you have your expenses going out. That's your profit and loss. If you make a loss and within your investment property itself, you may be able to use that loss to offset against other income in your tax return. So let's just say you're working, let's just say as an accountant, keep it simple for me, you love your job, everything's great, and you've got an investment property that is losing money. You may be able to use some of those losses and offset it against a successful income. And that's what negative gearing is all about. Now, if you have any questions on this, just put your hand up. This is a real life, this is not a real life, this is a worked example. Some of the figures are a little bit weird, but let's just say that an investor's purchased a rental property for $500,000. It's a great little investment property, $500,000. I don't know what type of property, Carla, would you get for 500 grand?
Oh, you could get a letterbox or a car park. Nah, you get a nice, we'll call it an apartment.
You get an apartment or
a townhouse.
Townhouse.
Yeah. House in some areas. 500,000 is nothing to be sneezed at, but
yep.
For the case study.
Excellent. For the case study, we're getting a $500,000 property.
Home.
Okay. And George has got the best interest rate on the planet, 5%. Well done, George. Thanks for that.
Awesome.
I don't reckon you could. I mean, what's the interest rate percentage is going for around roughly now investment properties?
For investment portfolios is about mid-sixes.
Mid-sixes, yeah. So this guy's really good. He's got 5%. He must have locked it in with you a couple of years ago. So we've got 5% interest rate, meaning that the actual interest you'll be paying for the year is $25,000. So that's how much you'll be spending just on interest, because you've got an interest-only loan. Let's just assume to keep it simple. And you're renting it out at $450 a week. So the total rental income for the year you'll be receiving is $23,400. So you can see it's close, but it's not quite there. Now keep in mind with rental properties, it'd be great if it was only those two expenses, but it's definitely not. You've got things like property management fees, which Carla charges, which are all tax deductible. They're all good.
Very reasonable.
They're all reasonable. You've got to maintain that property. You've got to pay for insurance. All of these additional costs, and you've got land tax, obviously that's a big one. All of these additional costs can equate to, let's just say for this example, $5,000. Again, to keep the maths nice and simple. So the total cost, therefore, of having this property is costing you $30,000 a year, and you're only generating $23,400, which means that you are losing $6,600 in cash every year by having this investment property. So going through, having a look at that, you'll be like, well, why on earth would you do that? Well, what negative gearing allows you to do is it allows you to get that $6,600 and put it as a tax deduction on your tax return. It's not that simple, but it allows you to do that. And the way it does it is, and I'll show you the next one. I'll just have to run through that again, a bit of another disclaimer. Please note tax laws are complex and may change over time, so it's important to consult your tax accountant in regards to that. So over time, using that worked example, the cash flow impact to that individual would be an out-of-pocket cost in 10 years of $66,000. Now that's assuming that there's no rental increase and that the individual's on a 39% tax rate. And I'll get to the tax rate in a second. Now, because the individual's on 39% tax rate, they will get tax refunds spread over that 10 years of $25,740. So you can see that they're really only out of pocket $40,000 in 10 years. When I say only, it's $40,000, but it's over a 10-year period. So that holding that investment property is costing them $4,000 after tax every year. Now, there's a few big assumptions in there. One is the maintenance cost could be astronomical. So you might have a situation where you may have 40 grand worth of maintenance costs in 1 year. The foundation might break or someone could slip. I don't know, Carla, what type of stuff do you deal with?
Get insurance.
Get insurance.
Get insurance. But no, things can happen where there's unexpected things. You might need to redo the roof tiles or something that costs a bit of money, or rewire the home, a few $1,000s there. You know, it all sort of adds up, things like that.
Some of the big ones that we see are bathrooms, issues and flooding in bathrooms. We see repainting occurring quite often as well.
Yeah,
so people do some
maintenance.
repaintance and general maintenance with that. So in short, you're out of pocket $40,000 in 10 years. So you're like, okay, you go to your account, say, I'm going to sell this thing. I've had enough of it. I can't afford it anymore. So the accountant works out, or you go to Carla. Carla goes, I'll get you nearly just under $900,000 for that property. Now, keep in mind, you've only bought it for $500,000. And it's in 10 years' time, it's about $900,000. Now, that's just assuming 6% capital growth. Carla, what's your thoughts on something like that?
Comes to making good decisions and informed decisions when you're actually initially purchasing property as well. So sometimes you see something and it's all sparkly and glitter. Oh, I want that. That's great. If you don't do your research and your due diligence beforehand, you could find yourself in a lesser situation than that. And we'll go on to that in a couple of slides.
Yeah. So what are you? I'm throwing it out there, Carla. But in regards to sale prices, I mean, 10 years is. There used to be a rule to say that if you buy a property in 10 years, it will double in value if it's a good property.
Yes.
Does that still apply these days, or would you say?
Sometimes it's even more so.
Yeah.
It really depends on the property type. So, for example, and there's nothing wrong with apartments, but that example that we're going back to again, where you're getting a really high rental return, you may pay $300,000. I've got an example of a property where somebody's just paid over just around $400,000 for the property. It's a little apartment, little flat, not a huge block, and they'll be getting close to $600 a week. So it's a different thing. When they go to sell it, I don't have a crystal ball, but I think probably they'd be looking at maybe $100,000 or $200,000 increase in that time, just based on what I'm seeing. But they're getting that money now. Now, with a home, if they spent the same sort of money in a home in an outer suburb, they might only get, say, $400, $450 a week in rent, but then when it comes time to sell it, they may be up to $900 to $1 million. So I've seen samples of that over the years, and it can happen, definitely.
So just assuming 6%, and this is where you've got to do your research before you buy the property. And I've assumed a tax rate 47%, and you're probably scratching your head saying, Mark, why do you say 47% when the individual's on 39%? Because a capital gain will push you into those higher percentages. If you make enough money in that property, you will be pushed into those higher percentages. And the reason why is because the way we calculate the capital gain impact is you've got your sale price, then you've got the lot less the cost that it is to sell. So that's the cost of Carla for selling it. Thank you, Carla, for giving me a good price on property.
That's commission and advertising, and it's pretty
exactly
reasonable.
Less the purchase cost of the property. So the purchase cost of the property could be things like stamp duty or legal costs associated, or just stuff to get it up and running to get it to a rental. This is where this line item here is where the accountant's going to work for you. This is where the accountant's going to say, okay, I need all of this information. This is very detailed, and in some cases, we can see these costs go from $15,000 to $150,000 just by researching and seeing what renovations and what work was done on the property. These are just simplistic. There's a lot of pluses and minuses, like once you get into depreciation, so I'm just keeping it nice and simple. Then you less your purchase price, so you made a profit of $360,000 on that property. I'm out of pocket $40,000 in 10 years, and I've just made a profit of $360,000. So you start thinking, well, that's pretty good, but then the government says, no, I want a piece of that. So you have to pay capital gains tax. Now, if this was normal income tax, nearly 50% of that will go to the ATO. Because of the capital gain discounting, the tax that you pay on it is $80,000, which means that you come out clear after tax and after you've paid your capital gains tax on that property of $280,000. So again, pretty good investment. The concern that you've got is that over this 10-year period, 10 years is a long time. So if you're spending $280,000 in renovations, then you're not really making much money. But if for example, you start increasing the rent, if, for example, the rates to 9 or 10% growth or doubles in value in that 10-year period. This figure could be astronomical, could be quite good. So it all depends upon the property. Every single property is different. There's no crystal ball, like Carla says, in regards to what's going to happen with the property. There are situations where the returns, the out-of-pocket could actually be positive, and then the capital gain is negative. So again, see the account to work out what it is. But in this case, this is your capital gains tax, which you've been hearing about on the news, and the saving in capital gains tax. So instead of paying 50%, you're only paying about 25% at a maximum. This is what's called, this line item here is the negatively geared aspect of what you're hearing in the news. So you can start to see that if they get rid of this and they get rid of this, the appealing aspects of property decreases a lot. It means it's probably a little bit more restricted to more people that are looking for primary residences.
Investment properties can appreciate in value over time. This provides an opportunity for capital gains that Mark spoke about in detail in the last slide. As the property value rises, you can sell the property for more than you bought it for. That's the aim of the game, to sell when the market is in a good state. If you don't have to sell, you don't sell. But if you need to sell, you're based on the market. I think that the rule of thumb is that you buy and sell in the same market if you are re-entering the market. So if you're just selling out, you probably want to sell when it's a seller's market, when the market's a bit higher and the prices are a bit higher. But purchases in this market now, so where we are at the moment, it's a good time for people to be buying because the market hasn't quite recovered from all those interest rate rises. I'm not sure, George, if you agree with that. It's kind of had a bit of an effect on where things have been at.
Definitely, and we are seeing a significant increase in the last couple of months in people getting pre-approvals to look to buy in the next or in the calendar year and get themselves set up now that pretty much we've hit the peak of where interest rates are. And they are potentially on a downward trajectory next year. I think people are getting a bit more comfort, especially because people have kept their jobs and there's low unemployment as well. So that safety of knowing that you're not losing your job and interest rates decreasing, I think, has caused that change.
Yeah, there's a bit more urgency as well now because people are a little bit worried that if the rates start to go down, the prices may go up and people will have that confidence again. So it's kind of, I feel like we're sort of on the tail end of...
There's a lot of talk of lack of housing as well, so lack of supply. And
yeah, there's definitely a housing crisis and there's not enough supply at the moment. So that's why rental properties are helpful for people needing somewhere to live. So importance of location. They say in real estate, location, 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 and it's very true. It's a crucial factor to consider. So for example, homes that are on main roads, backing onto train tracks, big high voltage power lines, they still sell, they just might take a little bit longer. You might be able to pick them up for a better price as a purchaser, but you've got to be aware that in the future, if you're looking to maximise your returns, you've got to be aware that you're buying it cheaper for a reason and you'll probably end up selling it more conservatively depending on where the market's at later. You know, poor location, but then being close to the train tracks is handy too. If you're near the station as well, you can, you know, just get right in. The good part of that is that tenants don't seem to worry too much about those factors because main roads, handy, easy location, close to all the amenities is really important. Whereas when you're looking to purchase a home, you may take a little bit more time with your due diligence and where you're going to live, you know, 3-4 inspections. I'm noticing with tenants, they'll come in 10 minutes, okay, yeah, I'll sign up for this one. And the next year of their life and probably longer, they'll be quite happy and content to be living in that spot without too much thought behind it. Could be school zone. School zoning is very important for a lot of people too, you know, to be in the right catchment area for people with children is helpful. Risks and mitigation. So it comes with inherent risks such as market fluctuations, tenant turnover, natural disasters. It's a bit gloom and doom, Mark. Mark wrote this one up. But then again, it does happen. So some strategies such as insurance, so landlord insurance, if your tenant decides to do a runner or unfortunately wreck your house in one way or another, having insurance on board, so those floods and different renovations needing to happen in the house, the repairs, that would be covered by that sort of thing. diversification and contingency planning. So that will help to minimise the risks, and having a chat to professionals like Mark and his team can help with that. So other factors to consider include condition of the property when you're buying it. So if it's an older property, whether it's been well maintained over time will make a big difference to what you have to do to put in. If you're buying a brand new home, there are things that you can talk to Mark and the team about with depreciation schedules, and you can claim a heck of a lot more there, which is very handy. Local rental market, so supply and demand again, and that zoning factor as well. So being in a desirable location where people want to live is always helpful, and the financial health of the borrower or tenant. So that's something that we do a lot of checking on when we are actually placing tenants into the property, just to make sure that it's affordable. They're not, it's not 80% of their income goes to rent. We like to, keep it nice and smooth so that they can afford to eat as well. That's always important.
So this is where I sort of mentioned in regards to conducting due diligence. So one of the reasons why you may be either watching this today or in the office today would be as part of your due diligence process to see whether or not an investment property or that particular property that you're looking at is suited for you. And that could be in the situation of cash flow or whatever else it is. But the key is to make sure that you review the property in regards to the risk associated with the property. So what I mean by that is just don't go into the property and fall in love with it and saying, oh, I love this property, it's so beautiful and all this, I'm going to pay top dollar for it and then have it as a rental property. You've got to look into it in regards to it as being an investment only and then take it from there. But if you are living in it as a primary residence, no worries. If you want to pay a little bit of extra for it, but then just keep in mind you do not want to overpay for a property. So keep in mind what the risks are associated with buying the property. Like Carla mentioned, there's certain locational risks that will mean that property may not go up in value as much. There might be a situation where, for example, the land value probably might not go up as much, or your proportion of ownership of that land is very small, or it's a new property. There may be a risk that a nice big apartment building goes up right next door to you, then all of a sudden it devalues. Those types of huge risks really have to be considered when you're looking into those investment properties. So do a lot of research into the property history, the property market and those types of areas, and just make sure, legal requirements to ensure the investment is a sound investment. Again, speak to your accountant, speak to your financial planners, speak to your brokers as well, speak to your real estate agent. Get as much information as you can to make sure that when you do choose to invest in a property, you know what the risks are. Managing cash flow, this is important as well. This is where I would sit down with a client and say to them, this is very similar to that example, to say, okay, that was a very simplistic example. When I sit down with the clients, I go through in a lot more detail, and I usually get them to send me half a dozen or so properties to just gauge what type of properties they're looking at, and also the risks associated with those properties and what type of potential cash flow will be associated with those properties. So the key is to make sure that you're actually earning enough to cover any sort of negatives with that property, and also making sure that if it is negatively geared, that you can effectively afford it. Very similar to like George said, you've got a couple, no kids, fantastic, heaps of money, they just bought themselves a nice little Porsche and all that, life's great. 1 or 2 kids later, their income halves. Can they really afford those investment properties? Should they be getting into it now? Those types of things. So have a look at your personal cash flow before you start investing into it. Speak to your accountant to just see what type of impact it will have on your life and whether or not it's worth jumping into it. The next one this is a very important one, which is making sure you've got a reserve fund of cash. So one of the things I do say to my clients is once I work out roughly what the cost will be for the property, is say, well, okay, let's just say you can't get a tenant for 6 months or even 12 months. Let's do the assumption that something happens to the property and you've got to fix something that's not covered by insurance, which is $40,000 or $50,000. Do you have the funds available? Do you have that buffer when you go invest into these investment properties? Just because you got the deposit may not be enough. You really should have that little bit of buffer, a little bit of extra funds available. Again, speak to your accountant. They'll work out with you in regards to what's the best options there.
So just the property growth rates in Australia, the capital cities. So this is over the past 10 years. You can see this one down here. So just bearing in mind, they're all positive. The lowest one is 26.53%, and this is Greater Perth. So we had a bit of a discussion group on this earlier, and we believe that it could be partially to do with the factors like the mining towns and things like that. So when those natural resources are high and people are coming there, there's a lot more interest in those areas. But the big ticket item that's gone up a lot, which had probably a lower starting point, is Greater Hobart. That's just phenomenal growth, and it's had a big spike in 2022 where you can see them all come up. Melbourne's tracking pretty well at 65.95%. So that's still very reasonable over a 10-year period. But yeah, the other capital cities are all doing reasonably well too. Look, past information doesn't often talk about what's happening in the future, and we don't know what that is, but Mark might have something to add here with these numbers.
I just find it interesting that, if you have a look at these two here, the capital cities have all sort of shot up a bit, but Melbourne sort of...
Canberra and Melbourne.
Yeah, Canberra and Melbourne just really haven't had that increase. Like everywhere else has had that little shoot up in the last year or so, but Melbourne's still sitting around there.
As a real estate agent, we'd say any time's a good time to put your house on the market. I know a lot of people say, oh, let's prepare it, we're going to hit the market in spring. Well, so's everybody else, right? So there's a lot of supply and the demand can go down in those sort of times. So winter's fine if there's less properties. Any time's fine, really. It depends on your own circumstances and when the right time is for you. Obviously, in a high seller's market, it's always beneficial for you to be selling. But as I said before, if you're buying again, you're probably going to be buying at that high time as well. So it really doesn't matter when you need to sell it. It just depends on your own personal circumstances and when the accountant says it's okay or is a good time you've got to sell that, or what you need to do, or you need to buy another one. Basically selling during a favourable market can maximise your returns. Looking for signs of a seller's market, like the high demand and those prices going high. Some areas only do a small number of sales per year. I'm looking in a particular area for myself. I think there's probably only about 20 sales in the whole year, whereas where I sell, there's probably more like 2,000 sales in the year. So it's interesting to be able to know when to put the property on the market. Financial goals, that's another thing. So reviewing your financial goals regularly with your financial advisor or your accountant can help. So if the property's gone up significantly in value in the time, it might help you achieve different goals. So you might be wanting to go on that holiday or putting debt down elsewhere. That could be something. Or even diversifying your portfolio. You might decide it's time to put some money somewhere else depending on your stage in life. Property performance, so evaluating the performance of your property. So if it's consistently underperforming and, with high vacancy rates or low rental income, where you're always copping a hit in that direction, the maintenance costs going up. So as the property ages, there's more money to put in. Might feel like an empty bucket there. Might be wise to sell and reinvest and buy something a little bit different where you can see some dollars and a bit of money in the bank. Changes in personal circumstances, I think we spoke about this earlier as well. You may be wanting to cash out and go on that trip that I mentioned further up, or just have some financial relief, because sometimes it's a bit of a challenge to be hanging on to too many assets and paying a lot of loans, so a bit stressful for people. Anything to add for that, Mark?
The changes in personal circumstances is probably one of the main reasons why clients would come to me and say, okay, Mark, I'm thinking about selling this investment property, and it is usually, yes, there could be a change in job. That's a big one. Health issues that occurs quite often. Unfortunately, as we get older, we're not as healthy as what we used to be. We start putting things in perspective and saying, well, do we really need that big of an asset that's just sitting there? It's generating a little bit of money. I may be able to utilise that now. My kids may be able to utilise that now. So they're the types of things that you really have to think about. Yeah, look, I'd say the burdensome one is the key one as well. If it really is impacting your life a bit, or it can really change your life. I've had situations when interest rates were quite low. So you had, I could have a client which has an primary residence, which has got a little bit of debt on it, and an investment property that's got a bit of debt on it. Well, they've both got a bit of capital on it. And they're looking at their life going, wow, if I just sold my investment property right now, I could then use that money and have no mortgage. That will completely change my life because interest rates are now sitting at 6.5%. Whereas when they were at 2%, it doesn't matter. $20,000 for $1 million loan is not a lot of money. But $65,000 for $1 million loan is a lot of money right now. So just repaying down that mortgage will have massive consequences to their life.
Okay, so there are a few little tips that help for knowing how to get the right price and when to sell and all those types of things that Mark touched on before. So if your investment is tenanted, it's really, really important that your real estate agent has a good relationship with the tenant that's in the property because they can make or break a campaign. We tend to work with the tenant and have them wanting to work with us because they could be showcasing themselves for their next landlord, or we inform them on how to impress the landlord with, a nice tidy home because sometimes you can tell, I tell my tenants, I don't want all the buyers to know if this is tenant. I want them to ask me the question basically, is it tenanted or is it owner occupied? Because generally speaking, sometimes you can really tell. With my properties, I'm proud to say that generally you can't tell the difference just because they want it to look good too. I always assure them that we will look after them with getting a new property if they do have to move out, but chances are if it's an investment property that's being sold, a lot of investors will show interest because you've got a tenant, a good long-term tenant that wants to stay on board. Staging appropriately for the value of the property. Sometimes it's appropriate, sometimes it's not. Sometimes virtual staging can help. You'd be surprised at what you can do online. So if you've got an empty property, it's always nice to have some staged furniture inside so when people walk in, their imaginations don't have to work too hard to know where the couch could go and the TV. But sometimes even with a property that's already tenanted, it might not be quite at the mark. So you can actually do some virtual staging as well, which just tidies it up. Just you can do a spray and wipe and all the mess is gone. So that's pretty cool. Removing personal items like photos and extra clutter, the fridge magnets with all the bills on the fridge. We just give that kind of advice and information to the tenants to do that, or even if you're selling your own family home. Just keeping clean and tidy at all times, both internally and externally. Hiring a gardener for the investment property just to get it nice and trim and cleaned up for the photos and for the inspections is always helpful too. Painting, neutral tones are always good. So if you've got a home that's got 5 different colours, like this room here has got an extra colour, if we were selling this and this was a home, it'd be a lot simpler and cleaner and crisper if it was just one colour. Obviously it's a place of business and it looks amazing, Mark. It's really fantastic.
Thanks.
Don't overcapitalise. So not throwing too much money into the property. A simple signboard is enough. You don't need billboard size out the front of the property. That's more about showcasing the agent or the agency rather than this is where the house is, stop here. You can have a little pointer board. Putting all lights on and ensure that the temperature is comfortable. If it's hot, have the aircon on. If it's cold, turn on the heater just so it's a nice, comfortable place for people to be looking at. Key tip, really consider the first offer. In a lot of cases, the first couple of weeks of going to market are the crucial time. So if you're priced right and you get a lot of interest in the early days, it's always good to come back with a counter offer or consider the offer that comes through. I know people are always waiting for the golden egg, but you can negotiate and you can get a great price at the start. So the highest interest is generally in the first couple of weeks of selling a property. Sometimes people wonder if it's been on for too long or a bit longer than some others, what's wrong with it? There might not be anything wrong with it at all, but sometimes vendor expectations versus purchase of expectations are a bit different to each other. It's basically our job to be the conduit between. So vendors are generally up here, purchasers are here, and we've just got to meet somewhere that's a happy place and hopefully over the top end of where we're all expecting. But basically, something to note that Mark made very clear here was that everyone wants to sell 10% above the market, and every purchaser wants to purchase 10% below the market. That's a really good thing to think about, really. So consider the opportunity cost of holding onto this property. So if you're waiting for that price to come, it might take an extra 2, 3, 4 weeks to get the price that you're looking for, but then the settlement time could be a bit longer and cause you extra financial problems as well. So,
I mean, I specialise mostly in business strategy as well as taxes. But one thing that's important to consider, especially when you put something on the market, is that usually the people in the first few weeks, they've been looking for a while. They know what they want. So you've got about 3 or 4 or 5 months of pre-marketing already done as soon as it goes on the website. Because they've been looking every day or every week or so, and they're like, okay, this property's just popped up. So you're capturing 3 months or 4 months or even up to 6 months worth of buyers within those 2 weeks, 2 or 3 weeks.
First 2 hours we get calls.
Yeah, first 2
Something
hours.
comes up, there's a lot of alerts out there.
Exactly. So if you think about it that way and say, okay, we've got all this interest, all this this opportunity in this first 2 weeks, oh, geez, I can probably make a lot of money on this. There is a chance that you've already exhausted 3 to 6 months of marketing in those first 2-3 weeks because of the backlog. You may have to wait another 3 to 6 months to get that same level of interest that you got in those first 2 weeks. So that's why sometimes you see those properties and they're like, oh, they're all really interested, and then they sit on there for 3 or 4 or 5 months later, and that's because they're still trying to catch up to where they were before because they're thinking, well, maybe it wasn't there. In short, the market is what the market is. The market dictates exactly what the price is, and if the market is already saying the price is that, then you have to set your expectations to what is realistic. I'm not saying at all just to undercut the market and just sell, sell, sell. What I'm saying is that really speak to the agent. They know the market. They're not out there to just quickly make, well, some of them are, but Carla's not. They're not just out there to just quickly just make a quick buck. In a lot of cases, they do know the market, and the higher that they make for you, the more they make as well. So
I think just to have an honest and transparent relationship with each other. So you need to be comfortable with your agent so that you know that you're having that honest conversation. You're getting the feedback on the good, the bad, and the otherwise. And that way you can make informed decisions and take the next steps logically and
exactly,
get it done.
And the key as well is this opportunity cost. The actual cost of having that much equity tied up is going up and up and up every time interest rates go up. So you've got a situation where, for example, you could use that money, and like I said to you, mentioned before, where you've got a situation where you can sell the investment property and put that money onto your mortgage. That's tax-free income, and that's tax-free at 6%, 6.5%. Times that by 2, that's 13%. You could get a 13% saving after, on comparable terms by just getting rid of that investment property sooner rather than later, or waiting for that potential increase. So if you have a look at the Melbourne property markets and the rest of it, a lot of people are just thinking, oh, property prices are going to go up forever. Well, we've seen on graphs, they sort of don't. They sometimes sit the way they are. Inflation goes up. Inflation's sitting around 3, 4, 5%. As inflation goes up, you really got to start thinking about saying, well, these opportunity costs are really going up a lot. Is it really worth selling it now and just taking it 5, 10% below what my expectation is, just to effectively get rid of it, and then use really factor in that opportunity cost. The key would be really sit down with your accountant with that. So a lot of tax agents will be able to do this as well, but your accountants definitely will, and they'll work out and say, well, what is the opportunity cost right now if I was to sell this property? Spend that extra time, book that extra meeting with them, and just say, I'm thinking about doing it. Can you do the figures for me just to make sure I'm on the right page? Or say, I've done the figures. Can you just check it? Get some certainty on it as well.
And the same goes with placing tenants in investment properties. We obviously want to get the highest return for our landlords, but if you have a property that sits vacant for more than a few weeks, even $20 over a few weeks, Mark can do the maths on this one, but you can be looking at 12 to 18 months to recover to get that money back, that $20 a week extra that you don't capitalise on taking a tenant that's a good quality tenant that's willing to pay the right market rate at the time. So I think it's all about just seizing the moment, really.
All right, fantastic. Thanks a lot, guys.
Thank you for your time.
Cheers.
Thank you.